All right, we are going live again. I've only done this a couple times, still getting the hang of it. And yeah, we're going to go live. So if you have any questions, comments, concerns about the mortgage industry, real estate financing in general, I've also got my little nerd hoodie on. Check it out. So if you're a nerd, whether it's mortgage, real estate, any kind of nerd, I just think it's fun. You can go to my website, nerdmerch.com. There's all kinds of fun, different categories on there. It really is kind of fun. I've got kind of this headset I've been playing with, kind of messes up my hair, but that's all right. So yeah, jump on if you have any questions about real estate, about credit, about buying, about mortgages, any of that type of stuff. I'd love to help you answer any questions you might have. I do lending in the states of Utah and Nevada, and I do everything from traditional financing, conventional FHA, Fannie, Freddie, all the normal kind of stuff that you get, all the way down to private money lending, investment lending, fix and flips. I often tell people that I sell money for a living when it comes to real estate. So if you have any questions about how some of that stuff works, this is a free opportunity to just kind of pick my brain and see if I can help you answer any questions you might have. So let's jump on and find a couple of fun little questions here. But I've been doing this since 1999, so I've done mortgage loans for quite a while now, and really like helping people. And I'm amazed at how many times I have people ask about credit, and they have very low credit scores and don't know what to do or why the scores are the way they are. And I think that's one of the things I can help the most with, is just going through and helping you with your credit and knowing why the credit is the way it is. Let's also, I think I can share this. Let me just see if I can get this shared to maybe Facebook. Oh, I don't know what that means, but okay. So again, I'm kind of new to this stuff, so bear with me a little bit here. If you have a question, you can jump into the chat. Let's see how that works. Okay, all right. I hope that works. Okay, so let's jump on and ask some questions here. You can check out my website at ryanbolton.com. That's where there's mortgage calculators on there. There's really some fun mortgage calculators, have like the difference between renting and owning, and there's just affordability calculators. I've got a couple built in. If you just scroll down to the first little section, my mortgage calculators are there. And of course, my blogs and other things that are on there to help with SEO and just ranking and all that fun stuff. But love to engage with you on there. But let's see if we can find a couple questions real quick. Why did the FHFA raise mortgage loan limits in 2025? It's often happens. In fact, there's a joke in the mortgage industry that the memes and the stuff that kind of pops out about raised or higher loan limits are going to start showing up all over the place, because a lot of times we can fund loans based on that new limit because the loan won't be sold until next year. And so we can kind of get a head start on those increase in loan limits. But a lot of it's just based on median income, median loan amounts. They always make adjustments of what is the conforming loan limit based on the average sales price, median prices, and they make those adjustments. Usually, it seems like it's been the last couple of years, right at the first of the year, they start making announcements of higher loan limits. And what this means is Fannie Freddie allows for this higher loan limit to stay within their lending world, within their guidelines. They call it the conforming loan limit. And there is some areas that are considered high cost that also have a tier that's above that for high cost loans. So it's very common to have an adjustment to that loan limit. And usually it seems like it's been January every year for the last couple of years. So why did they raise it? Just because the average price, the average loan amount that has gone up. So they make that adjustment every year. Is it possible to obtain an FHA loan with low income and bad credit? If so, what is the process of getting approved and buying a first home? The answer is yes. There is lenders that will go down on credit scores. With FHA, there's some that go clear down to like a 500 credit score. Some of it is why it's the score the way it is. It's not just like the number is all equal. There's a reason why the score is. Now, if everything's late on the credit report, currently late, charge-offs, judgments, bankruptcy, all of those things is why the score is lower, then the answer would be no. But if it's something where there isn't a bankruptcy involved, the credit scores are low because of lack of some history, or just have one account and it's bad, or you're in the stage of rebuilding, you will be able to get certain mortgage loans. Now, the down payment requirement also usually increases. When you're under a 580 score, most of the lenders that do that want 10% down, even with FHA. If you're over a 620, you actually start getting some of the 3.5% down options, or even some of the down payment assistance starts kicking in, 100% financing starts kicking in. And I'm telling you, it's not crazy hard to get from a 550, 570 score to a 620 score, depending on why it is the way it is. Now, a lot of people that start going through credit repair, they actually go backwards a little bit because they just start doing it the wrong way. So there is right ways to make sure your score moves up as quickly as possible within a certain time frame. But I'm amazed at how many clients I've been able to work with for 90 days, 120 days, a couple of cycles, couple 30-day cycles to get their score into that middle sixes, lower sixes, which opens up a whole new realm of financing. And just your interest rates are better, your down payments requirements are lower, even 100% financing kicks in. So it's worth putting the effort into getting the score up if you do it correctly to then get better loans. If you have a better loan, lower down payment, your buying power can go up, or your credit on everything else gets better. So car loans, mortgages, insurance, there's so many things tied to credit that working on that is really a good first step, and it's worth taking a couple months. I see way too many people that say, well, my lease expires next month. I need to get something else. They're raising the rent or whatever it happens to be, so I need to buy a house. It's like, man, if we just had a couple months to work on this stuff, we could have got you a better loan and you could have closed and moved right into your first home. But so many people, unfortunately, with bad credit, think about it for a day, want to fix it, and then they just keep forgetting about it. They don't do the steps necessary to improve their credit. And sometimes it's medical. Sometimes there's other reasons why they have bad credit, but most of it's just lack of knowledge and lack of paying things off and just bury their head in the sand. They just kind of forget about it. And then all of a sudden they need credit and it's horrible. It's like working on it now is so much better than trying to fix it rush or trying to get into something at last second. So start working on your credit now. There's so many things you can do right now to start working towards better credit. And it's just an accomplishment, a pride. There's so many things that tie into credit. Working on your credit's going to be the first step. So the answer is a lot of times, yes, you can get a loan, but you'll get such a better loan if you work on your credit first. So if you have any questions, you can pop in there. Let's see. Let's go to the more button here, find a few more. What credit score is used by lenders most frequently? So most lenders are going to pull all three credit bureaus, Equifax, TransUnion, and Experian. Then they'll take the middle score as your quote unquote credit score. So it's not like we all take Experian or Equifax or TransUnion. There's a formula of taking a middle score. So it can be whichever one's the middle score. I would say typically in Utah, Nevada, Experian seems to be the lowest. Equifax seems to be the highest, and TransUnion seems to be the middle more often, but not every time. Also, you do see some lenders that will take two credit scores and take the lower of two. So there is a little bit of a formula depending on what's happening. Also, what you'll see is the lower of the 2 or 3 or 4 borrowers. So let's say you've got a husband and wife, the husband's scores are lower, the wife's scores are higher, they'll take the lower middle score of all the borrowers on the file. I am seeing more times where roommates or a couple of friends are getting together, buying their first home together, and you'll have 700 score, 700 score, and then a 620. They'll go off the lower of whatever borrower is on the file of the middle score. So I hope you're following along with how that works. So there isn't just one score we take the middle of the three of the lowest of any borrower on the file. So I hope that helps. Quite a little rabbit hole there. Let's see. What condition does a property have to be in to qualify for an FHA loan? Really good question. A lot of safety things, code things, all those things have to be done. You really can't get a distressed property or one that needs some work with an FHA loan. The appraisal is required to check more things than a conventional appraisal. They're going to check the roof a little bit more. They're going to get in the crawl space. They're going to check if the function of the home is working, water heaters. They'll turn on the faucets. They don't check every outlet. It's not a home inspection, but it is a little bit more thorough, or a little more things are checked on VA and FHA loans than on conventional loans. And a large part of that is, one, you usually have a first-time home buyer. You usually have somebody with limited funds. They want to check and make sure they're not buying a home that's going to cause them financial hardship by having a bunch of repairs that are needed, or something where they go into foreclosure because they can't fix the house and now they got all these repair bills and they can't make the mortgage, and all of a sudden it goes into foreclosure. Because many FHA loans are a much higher loan to value than even conventional loans. So there's a little more scrutiny on an FHA appraisal, but it will be any kind of really major deferred maintenance. There's going to be safety things. You'll see where like railings, if the staircase doesn't have a railing down the side of it, that's going to be an issue for an FHA loan. So they want it really livable, very livable, move-in ready, not a lot of deferred maintenance with FHA, more than other types of loans. Now, FHA does offer a rehab program. It's called a 203K loan. This is a loan that allows you to purchase with FHA and move in some of those repair costs as part of your loan. So take a look at that if you have a home that is distressed. There's two versions of the 203K. One's more cosmetic or little things. Then there's ones that are more bigger repairs, things that may cost more to get it done. So you can use that loan with FHA, but most commonly the home needs to be very inhabitable, not a lot of deferred maintenance, kind of move in ready for an FHA loan. One other thing that you can do is if you have a property you have only owned for a short period of time, like a fix and flip property, you can't use FHA financing until you've been on title for 90 days before you can. And then there's even some criteria there, then 6 months. So there's some criteria on getting a new loan with FHA after you buy a distressed property. But there's some nuance there that we can talk about if you have any questions on that. But the real question there, the condition of the home needs to be very livable, no deferred maintenance, definitely no safety concerns. Those types of things are what they're going to check. What is the difference between condo insurance and renter's insurance? Very little. There's an HO6 policy is what it's called versus renters, but it has very similar, it really is very, very similar. They're different things because you own the property versus renting it. So there is some criteria that has to be different there, but it's very similar. The name's a little different. It's called an HO6 policy where it's like a condo or attached townhome or something where there's a master policy for the building and you're just getting insurance for liability on the inside, theft, vandalism, that type of stuff, more personal stuff on the inside of the unit itself. So renter's insurance is very similar. Usually policies are very similar, the verbiage is very similar, but they are kind of different just by name only in most cases. What else we got? Let's jump into this section here. If you have any questions, please post them in the chat. I'll keep an eye on that. But I'd love to answer any questions that you have about real estate financing, mortgage financing, all that stuff. What other steps do I need to take to get a home loan approved? Very first step is the pre-approval, which is the application. The application allows us to narrow down what loans you're going to qualify for. This allows us to kind of check certain things, credit, debt ratio, time on the job, where you've lived, where you've worked. It kind of gives us the snapshot of what loans will qualify with that particular scenario. So the first thing is talk with a mortgage lender. Don't talk to a real estate agent first. You want to find out what you're qualified for first, then go through the process of what loan requires certain documentation. So there are certain loans that we can do that don't require taxes and income and all that on, like DSCR loans or investment property loans, where other loans require 2-year tax returns and bank statements and all the other things. So every loan's going to have a little different nuance when it comes to what documentation you're going to need. But that application really helps you narrow down, okay, what loans do I qualify for? Which loans am I just missing on that I can work on to try to get to that loan tier? And that's really where the application helps us the most to answer those questions for you. So always start with a mortgage lender. Start with the application. Go through that step. I'm amazed at how many people wait on that step. And it's like that is the step that leads to all the other steps. So first things first, get the application in with a local lender, with somebody that you can check with referrals, check on their reviews. I'd love to work with you in Utah and Nevada. We are licensed in other states with a company I work for called Patriot Home Mortgage. So if you need help in a state that I'm not licensed in, I can get you a good referral. But start with the loan officer. Start with the person on your team that's going to work with you to get the loan approved, and find out what you can even go shop for. Find out what documentation you even need. They're going to help you with that. I often tell people, you're not supposed to know how this stuff works. That's why you have me to walk you through it. And everybody's scenario is a little different. We have all these boxes, all these underwriting boxes that people have to fit into, and you're not going to fit in every single one of them. Knowing how to kind of get around them, or which loans will accept it, which loans won't, that's part of my job, is to help you know what loan you'll even qualify for. So that application is definitely the first step. What else do we got here? And then you can answer, and let's see, check the chat here real quick. Okay. Let's see. Can I buy a new house if I still owe money on the current one? Yes. You'll have to qualify debt ratio wise for that old debt plus the new debt. So that's probably the biggest reason you couldn't do 2 houses, is more debt ratio. Also, if you need the equity from that home as the down payment on the next home, that's where there may be some hoops you have to jump through. But the short answer is yes, it's dependent on debt ratio. You still have to qualify for your exiting property, and now you have a new mortgage, you're going to have to qualify for both debts. If you can, you can get 2 houses, 3 houses, 4 houses, as many as you can get with your debt ratio. Usually what you'll see people do with multiple houses is they have to rent the house to show some income to offset that mortgage payment. That's how you start seeing people keep the home that they're in, turn it into rental, move on to the next house, and kind of keep building a portfolio by moving into the homes to get started. But it's not like having a mortgage prevents you from getting another mortgage. It's simply a debt ratio qualification, just like a car loan. Can you get another car loan if you have a car loan? Sure, as long as you can qualify, as long as you have enough income to debt service both loans. So really, that's a bigger factor. Is occupancy is part of it, but the bigger factor is debt ratio. All right, what else we got? Good questions tonight, guys. Good questions. What ways are there to lock in a low mortgage rate without having to purchase a home? What ways are there to lock in low mortgage rates without having to purchase a home? Well, the mortgage is what is used to purchase a home. So you don't lock in a mortgage rate without having a property that it's tied to. That's a really interesting question. So what ways are there? None. Zero. There is no way to lock in a mortgage without having a property the mortgage is against. The mortgage is the loan for the home. So if you don't have a house, you don't have a mortgage. The mortgage is what you're using to purchase the home. It's the collateral for the mortgage is the house, right? That's so there's no way to lock in a rate right now with like trying to lock in a rate now and wait to buy the house 2 years from now or something like that. That's that doesn't work that way. Can I get a loan for construction of house on my father's agricultural land? Yes, you can do a construction loan. The problem with agricultural, you have to make sure that there's utilities, there's other things and building permits. You'll have to check with the city on what you can put on that land. But yes, you can get a construction loan that will give you the money to kind of build whatever you're trying to build. But you have to check with zoning, you have to check with permits, a builder, you have to check on what has to be built there, what utilities are stubbed to the property. If it is just purely agricultural and you don't have utilities, then you have to show, okay, how are you going to make the function of the house? Is it a septic tank? Is it going to run on a propane tank? Is it going to have a well on the property for water? Those things make it more and more difficult to get the financing. You want to make sure there's at least public utilities in most cases. But the short answer, yes, you can get a construction loan to build a house on land if all the other boxes are checked. Let's see. What are reasons for wanting to pay off a home loan quickly? The most common reason I hear people is they want to retire and they don't want a mortgage payment. That's probably the most common thing people are trying to accelerate to just eliminate that mortgage payment and just not owe the interest on it. Obviously, if the loan's paid off quicker, you pay less interest over the life of the loan. If you make all 360 payments on a mortgage, you're going to pay a lot in interest over that entire time. In fact, usually the first 5 years is almost all interest on these mortgage loans because they're spread out over such a long period of time. So people that want to accelerate are just interest conscious, so they're just trying to get rid of that interest payment. Or what I see most commonly is people trying to retire. They have a date of 10 years or 5 years, whatever the date is, and they start saying, okay, I've got to start paying X amount to make sure I'm just mortgage free by the time I retire. And here's my advice when it comes to that. I think that's great. Getting rid of the mortgage is great. But I think getting rid of other debts because the money goes further is what I would do first. Also, I would fund retirement first. Get money into retirement accounts because that is more liquid, more accessible, better interest rates potentially. There's just more things to diversify with that retirement savings than plunking it all onto the mortgage. Because once you have that house free and clear, how do you get to that money? You have to sell or refinance. Where if it's in a retirement account, you have more access to it that's still while you're maintaining the debt. So there's a balance there that I think a lot of people miss out on. I had so many people I've seen that just pay every dime they can to get the mortgage paid off. They spend 10 years just accelerating that mortgage, getting it gone, then they get to enjoy it for 2 or 3 years. Or something happens right after they retired. Now they don't have their income. They can't qualify for a loan. They got all this equity they can't get to. Then they have to look at a reverse mortgage or something like that that's way more expensive than a normal loan. I think there's a balance. Sure, pay some extra to the mortgage to get rid of some of the interest, get kind of accelerating it. But I think you're far better off to take that $1,000 a month, make sure all the other debts are gone first, and get that into some sort of investment vehicle, some sort of retirement vehicle. I think is way better than just a whole bunch of money put on the mortgage. I just see way too many times where people do that and don't have much to show for it. The home's going to appreciate regardless of what you owe. Would you rather have $100,000 in equity without the payment, or $100,000 in an account you can get to? I think there's a balance there. So that's a little soap op, and I can talk to you more. You have a family member, parents getting ready to retire, something like that. I'd love to talk to you about some of these numbers that are specific to their scenario. But I've run the numbers so many times. It's like, okay, 10 years of paying extra or 10 years putting in a retirement account. What will have more money when you're done? Every time I've run the numbers, having more money in the retirement account is better than having the house just owe less on the house. It just makes a ton more sense to have that more liquid, more accessible. All right. How we doing? How we doing, guys? Doing good? All right. All right. What else we got? How long have we been on here so far? Okay. So if anybody has any questions, please pop on. I even see questions after the live feed that I can answer. So if you're missing the live feed, just go ahead and ask a question. I can answer that later. And again, if I can help you with a loan, that's what I'd love to help you with. That's what I do for a living is do mortgages and real estate financing. But I also like helping. I just like answering questions, helping you through this process. Or if I do lending in Utah and Nevada, if I can't help you in those states, I can refer you to somebody that can. But I'd love a chance to work with you and help you with this whole process. Can a home loan be transferred from one property to another? I have heard of that in the past where lenders will allow that transfer, but I have not seen that in a long, long time. Maybe somebody on the chat can comment on that. I have not seen the transfer because the way that loans now are securitized, the way they're transferred from servicing and things like that, gets very difficult to just swap properties with that same loan, because part of the idea is they want to get paid off, use that money on new loans, update guidelines. There's different risk that would happen when you switch properties. So for instance, you're buying a house at 80% loan to value. They know that, okay, now you've been paying it for a while. The risk is getting lower with every payment and the home's appreciation. Starting that over, they want to kind of also reassess the risk. So generally, no. And I think this question is probably popping up more because people have these low interest rates. They want to take their mortgage with them. But unfortunately, it's just not the way they work. I don't know a lot of lenders that want to transfer. They do want to update the interest rate. They want to update the guidelines. They want to update the risk portfolio, because you'll have somebody that gets approved for a loan 5 years ago. Maybe they've changed jobs. Maybe they've changed credit scores. Maybe they've gone through a divorce. Maybe they've gone through all this stuff that now they need to requalify under new guidelines with a new property, all those things. So I don't see a lot of lenders that are willing to kind of transfer that money. Plus, let's say you only owe $200,000 on the loan, you want to buy a $400,000 loan. They're not going to extend. You're going to have to bring all the difference down with money down. And that's why I don't see a lot of them. I remember there was a time where lenders had some guidelines, maybe local banks and stuff like that would be interested in some sort of transfer of the debt, but it's really gone away with the way mortgage has been securitized over the last 10, 15 years. I don't see a lot of that being an option. But if you know of any lenders, correct me if I'm wrong, if you know lenders, or if you are a lender, if you are a bank that does this type of thing, that has a transfer feature built into your terms, I'd love to see it, but I haven't seen any of that in decades, decades and decades. So, okay. Let's see. Let's see. What are some tips for shopping for mortgage when rates are low? So this is something that I tell a lot of my clients. We all get the money from the same sources. We're all checking everybody's rates every single day. I get all the rate sheets. They all get compiled into our systems. We're able to kind of check every single rate every single day, especially when you're talking the best rates that are out there. Now, the loans that are a little off the traditional, those you can see a little difference in rates with lenders that are more comfortable with a certain loan program, or like a certain box that the client can fit in, that just kind of gravitate towards that loan, may offer a better rate over here than over here. But when you're talking FHA, Fannie, Freddie, Utah Housing, all these, the rates are very, very, very similar, because we're all getting the money from the same sources. What you're really going to see is different with lenders is accessibility, like how they answer their calls, emails, how fast you can get a hold of people, how you get your questions answered. And you'll see loan fees can be slightly different. Maybe one lender charges $9.95 and $4.50 for processing. Another one charges $12.95. And so the fees can be a little, the other fees associated with just running the business and paying for staff and paying for some of the hard costs, that might differ a little bit. But I'm telling you what, I've been in this industry a long time, and we all get the money from the same sources. That's not really going to differentiate lenders that often, unless it's a nichier product, something that's a DSCR or subprime or non-QM. Some of these other little niche products can definitely be different. Private money can be really different. But when you're talking Fannie, Freddie, FHA, VA, it's not going to be a huge difference. It really isn't. Now, loan officers' compensation can be a little bit different, but it really is crazy how close really the rates are. And we're checking rates every single day. They're all coming into there's systems that everybody's using to check everybody else's rates are all coming in, and that's the rate. So ever since Dodd-Frank and ever since some of the loan officer compensation rules, all that kind of stuff, it really has gotten pretty standard on what interest rates are available. The best things you can do is help your own individual profile. More money in the bank, better credit scores, occupancy, those things are going to help your rate more than shopping it around with other lenders. And I'll tell you this, I'm amazed at how many people don't shop. I'll talk with people, oh, I've already got my pre-approval. They check with one company and that's it. People don't shop. They don't want their credit pulled again. They want to work with somebody they trust. Pre-screen on the front end, find a lender that works. I'd love to be that lender for you, obviously, but it's amazing how many people don't shop. I'll be calling leads. I'll be calling people that are calling in, or an agent will refer me somebody that already says they're pre-approved. I say, well, can I get you a second opinion? Can I check to see what we can do? Maybe I got different programs they have. No, I'm good. I'm good. It's a $500,000 purchase, but I'm good. I'm just amazed how many people don't check around a little bit more. But I would say that that's the best tips is shop the person, shop maybe fees. You're not going to see a huge difference in interest rates. You really aren't. All right, let's see. How do I find the best loans for a first-time home buyer? Same kind of thing. We all have the same programs. We all have the same guidelines for first-time home buyer programs. So it's really about shopping the loan officer, how experienced they are with dealing with first-time home buyers. You can ask them about their down payment assistance programs. What offerings do they have to first-time home buyers? Because there's some lenders that don't gravitate towards that. There's some loan officers that only want to deal with jumbo loans or only want to deal with construction loans or only want to deal with, so there's going to be loan officers that kind of gravitate towards certain types of borrowers. So it is something that not everybody does first-time home buyer program or has as many tools for that type of borrower, but I'd say first-timers are very, very common, and there's a lot of programs out there that a lot of us use, and they're, again, same kind of programs. Guidelines are the same. It's not like, oh, hey, this lender has a guideline and this one doesn't when it comes to FHA loans. No, FHA sets the standards. We follow those guidelines. That's what determines the loan. So there might be overlays. There might be things they add to it, but there's going to be the base guidelines are going to be the same no matter what lender you go to. What else we got? Any questions? Let's see. Oh, it looks like the chat was disconnected for a while. Oh, all right. Okay. I just got a warning here that popped back up. So if you try to get on the chat now, you can jump back on that. Didn't know that was down. All right. We're just having too much fun today, people. All right. I've only done a couple lives. I'm kind of still new to it. I've done my podcast, and that's live when we're recording it, but not live as it's going out. So I don't try to do a lot of scripted stuff. I just am what I am, and here we are. All right, let's see. What do you think about reverse mortgages? Just like any loan, it's going to have pluses and minuses. It's going to have benefits, disadvantages. It's trying to fit a need within the market. And where it works, it's a great loan. Where it's designed, what it's supposed to do is great. Has it been oversold in the past? Has there been some issues within the past? Yes. A lot of that's been worked out. A lot of that's a better loan than it was 20, 30 years ago when it first came out during the Reagan. Reagan kind of was the guy that put it into the during his administration, kind of started working on this idea of a reverse mortgage, and it wasn't great for the first couple of years. Had a lot of weird things happen, and since it's been kind of adjusted and played through the market and figured out and worked out the kinks, so to speak, over the last 20 years, it really is a good loan for those that need it. I think times it can be oversold a little bit. There is some downside with it. I think one of the most common downsides is people don't realize it does have an interest rate, and that interest rate raises the balance. It's not a free loan. If you get 200,000, you're going to owe more by the time grandma and grandpa or mom and dad or you pass away. You're going to owe more. So instead of making a payment, your equity is making the payment for you. So you just want to be aware that it is going up. Now, it's not designed to be a very high loan to value loan. It's not designed to be an interest rate that really is supposed to dramatically eat up the equity and you get upside down really quickly because they're only loaning half of what the house is worth. But it is, and the appreciation should help offset what that balance is going up. But I tell you, it's been some of the more great loan, feel-good loans I've done is people that need a reverse mortgage. The husband's passed away. The wife has all this equity. She doesn't have a job. She doesn't have any income. She has all this equity. She wants to stay in her home. I mean, I've seen some really good feel-good stories that tie into reverse mortgages. Because if so many people have all this equity, they can't get a normal loan. They don't have a job. They can't qualify. And they just live so poorly in just such a poor situation when they have all this equity if they do a reverse. So it has some pluses and minuses. I think mostly pluses, but it is something where you still want to have your eyes wide open as you're going into it. And I can get you a great referral. I don't do reverse mortgages because I have two guys I use that are just way better at it. I'd rather refer that type of business to make sure they're taken care of, and that's all they do is reverse mortgages. So if you need some help with that throughout the country, I can help you with a reverse mortgage, a really good referral on that. If I take equity out of my house, will my mortgage go up in price? No. Your note on your first mortgage is locked in. That's a separate loan. If you take out equity on a second mortgage, it's a separate loan. Now, if you're refinancing the first to pull out equity, it could. Depends on the interest rate that you have. So it depends. It depends on what type of refinance that you're doing here. But when when I hear take out equity, most common is an equity or home equity line of credit. But if it is a new first mortgage, so so you say that you owe 200,000, you want to pull out 50, and you do a new $250,000 loan. Well, it depends on the rate that you had on the original 200,000. And I would say most people have a lower rate on their mortgage. If you've had your mortgage for 2 or 3 years, it's lower than what you can get today. If you had it for 5 years, it's definitely lower than the interest rate you can get today. So most people aren't looking at a first mortgage refinance to pull out equity. They're looking at home equity lines of credit. And I can help you with that. So if you're looking to do a home equity line of credit, we can help with just a second mortgage so you don't have to give up that great interest rate you have on your loan. And I see a lot of people doing that. They're like, well, we've been in the house for 5 years. We really need to upgrade, but it's so expensive to jump from our low interest rate and our low balance to the new home prices that are available. That's where home equity line of credit can be a great option, because then you can pull out the money to do the remodeling or refreshing or redo the kitchen or add addition or add in what's called an ADU, an auxiliary unit, that maybe for the kids or something, or even to rent it. Or there's a lot of things you can do with your existing equity where you don't have to refinance that first mortgage if you have just a great interest rate. So I'd love to talk to you about a home equity line of credit. I can show you how all that works. So check out my website at ryanbolton.com, put a comment here, I can reach out to you. But we also offer lines of credit or second mortgages. How do people with no income afford their mortgage payments? They don't. If you have no income, you're not going to be able to afford a mortgage payment very long. Maybe it's on savings, maybe they have some Social Security, maybe unemployment, maybe some of the benefit to at least keep their mortgage payment going before it goes into foreclosure. But if you have no income, your your collateral, your house, will eventually be going way back to the lender because you're not making that payment, that debt obligation anymore, and you're going to be losing that house sooner than later, depending on how long you can keep the payment going with no income. So it's either unemployment, Social Security, disability, other things that are paying it, or just savings. They're just having to milk their savings so they can sell the house. I mean, but yeah, how do people with no income afford their mortgage payments? They don't for very long. That would be my answer, is they're not for very long. They're going to be having to tap into their savings. How do I get a property valuation for 95% of a home loan? Is it possible? How do I get a property valuation of 95% for a home loan? Is it possible? Terminology there doesn't make sense. All right, sorry. Don't know how to answer that one because that doesn't make sense. How does a mortgage work? And how does it give the bank ownership of the house? It doesn't. Boy, that's a common thing. They do not own your home. Just like the car loan bank doesn't own your car. It's the collateral for the loan. They do not have ownership interest. They do not have ownership rights. It's not like the lender can just show up and say, well, I'm part owner of this home. I'm going to use it this weekend. I've got some friends coming into town. I'm going to use your house. It is collateral for a loan. It's not ownership. They don't own your home. You own your home. You can sell it, you can refinance it, you can use it how you want, unless it's against the law or against the CC&Rs or an HOA or something like that. I mean, there's other things that can restrict how you use your own home, but mortgage companies don't own your home. If they do, they have foreclosed on it. It's part of their schedule of real estate, which is a bad thing. They don't want to own your home. It's the collateral that if you don't make your payment, they get to take something back. They get to take an asset back that they can reclaim the money that they loaned you. It is collateral. It is not ownership. Can you lose your mortgage if your home insurance is canceled? No, but the lender's most likely going to put on what's called forced place insurance, and it simply protects their loan balance. It's not going to protect you like a normal homeowner's insurance policy will. So it's a lot more limited, and it's usually a lot more expensive, So it's basically a forced place insurance. If your insurance cancels and you can't get insurance, they're going to put some sort of insurance that just protects their interest in the property in case the property burns down or has an issue. They're going to put that loan insurance, basically just covers the loan balance in many cases. But they can't cancel, you can't lose your mortgage or cancel your mortgage without the insurance. They'll just put some other insurance in its place that's usually more expensive, usually. I think this is happening more with fire zones, um, hurricane zones. I mean, there's definitely insurance that's going through a lot of changes over the last year or so. And so there might be a lot more mortgage companies that are having to put on forced place insurance. But you want to check the rates on it because usually it's usually more expensive than just getting normal insurance, and it doesn't have nearly the coverage. It doesn't have the liability, it doesn't have the theft, doesn't have the personal effects. It doesn't have any of that type of coverage. They're just covering their loan amount. That's it. Let's see what else we got. Any questions? It looked like the chat turned off for a while. So if anybody tried to chat, yeah. Let me check. I want to make sure that's up and running because I might have lost a lot of time there on the chat. But yeah, jump on. Let's see if you have any questions, see if you have any comments, see if you stump the mortgage nerd. Let's go for a little longer here. Let's see what else we got. What can homeowners do if their mortgage lender will not lend to them due to spray foam insulation? What? What can homeowners do if their lender will not lend to them due to spray foam insulation? Boy, that's an interesting one. Uh, if it's not done correctly or if it's something where it's just not covered up, I mean, I don't think I've seen a single lender that knows what insulation's even in there unless it's just exposed. It's like just exposed insulation. That was just posted 5 minutes ago. What can homeowners do if their mortgage lender cannot lend to them due to? There's got to be another reason. That's a weird one. I can't see why a lender, one, would even know what insulation's in there. Two, why that's an issue, and three, yeah, it's got to be exposed. There's got to be some reason where it didn't qualify or it's hanging. Yeah, that's a weird one. I would have to know more about that to answer that question, but there's got to be more to that question than that. What is the process of applying for a property loan and what should I expect? So the first thing is to do the application. They'll ask certain questions about where you live, where you've worked, what debts that you have. If you file bankruptcy, judgment, foreclosure, the whole application allows us to nail down what you should expect on the next step. So the first step is that application. It allows us to narrow down what type of loans you'll qualify for, what documentation we're going to need to verify, what loans you won't qualify for, so it's not even worth trying. That's the process. Then you're going to get a checklist from the loan officer that says, okay, I need this documentation to prove what's on the application. You say you make $10 an hour, $20 an hour, 40, whatever you make per hour. You say you make $100,000 a year, whatever that number is. Now we got to prove it with W-2s, pay stubs, tax returns, that type of thing. If you say you've got money down, where's it from? So the application allows us to give you a checklist of what we're going to need. But the most common things are going to be verifying any down payment, verifying you have reserves on top of your down payment, verifying your income and your assets, and verifying occupancy. I mean, there's other things we do, but these are the things we're going to have to document. And I tell you what, the mortgage industry is very heavy on documentation. We want proof of what's happening. We want proof on the proof. And we usually have a lot of guidelines and checklists of what to get to you to be able to show you what we need for a certain guideline. And there's always a why behind the guideline. There's always a reason for it. So sometimes we'll ask, okay, we need this. And the client said, well, I don't have that, but I have this. It's like, okay, once you know the why behind the condition, then you can get the what a little bit easier, even if it's not exactly what we normally get. People make their income all kinds of different ways. People have assets all kinds of different ways. It's a very cool industry in the sense that we have all these guidelines that we're trying to fit, and there's a guideline for every stupid thing you could ever think of. And there's a guideline for that guideline, and then you turn in the paperwork and say, well, now that triggered a different guideline. So part of my job is just try to screen some of that to save you some hassle, but there's a lot of stuff that can pop up as we're working through the loan, and there's always a why. And we're not just giving you a checklist just for the fun of it. So like, let's see what kind of paperwork we can get from our clients today. We get that thing and say, why do you need that? Well, there's a why, but a lot of times we're not just asking for it because we need it for no reason. There's always a guideline. There's always a condition that ties to the documentation. And most of it's proving what's on the application, proving kind of what we have on the application to be able to make it work. So really the very, very first step, get with the loan officer, start that application process, start gathering up the documentation as quick as you can, because I can't tell you how many times people tell me their income, we get their income paperwork and it doesn't match. They round up, well, I work 40 hours a week at X amount per hour, but they don't average 40 through the whole year. Maybe they average 38.6 hours, or they had some time off, or something just doesn't match. And that's part of our job, is to go through and just get the application where it's approvable. So that's what I do, is just recommend starting with that application process. All right. I really hope the chat's working, because I have a little error here. It said it was disconnected. It reconnected. So hopefully it's still connected. So I don't see any new chats. Anyway, so I hope that's working. If not, you can answer after the video. I can answer those videos as I see the comments. I can answer questions later on. Oh, where's a good one here? Do people who already have mortgages benefit from a decrease in mortgage interest rates, or is it only beneficial for new home buyers? So it can benefit. So let's say you have a 3% interest rates are 7, they move to 6. Well, it doesn't really affect you. You've already got your interest rate at 3 or 4%. So having lower interest rates doesn't really benefit your mortgage. It does benefit potentially your value of your home, because now as interest rates go down, maybe there'll be more buyers. So then values can be going up because there's more interest, more demand, that type of thing. So there can be some changes like in a macro thing, but micro kind of down to you. No, it doesn't really matter if you've already locked in your interest rate and you've locked it in for 30 years and you're at 3%, 4%. Doesn't matter if rates go from 7 to 6 to you. Now, the new buyers, yes, new buyers are like, okay, I can't qualify at 7, now I can at 6, or my buying power goes up, or something changes. For new buyers, that definitely affects new buyers more than the old buyers, or people that want to upgrade. So somebody that does have, let's say, a 4% interest rate, and they want to upgrade, they need to relocate, they want to downside or upsize or whatever with their home, and they're kind of waiting for that interest rate, that can benefit them. But the general answer to this question is no, it doesn't change your interest rate or really benefit you directly necessarily. It's more other things that can benefit. Now, the quick thing I have to say about that, there's a lot of people I talk to, they're waiting for a lower interest rate, especially in the lower price range. That 300,000, 400,000, that kind of that lower price range in most areas, they're waiting for that lower interest rate. Well, now you only have 2 buyers for a home. Let's say there's 2 buyers that can qualify at the 7% interest rate. Then all of a sudden it gets to 6%. Now there's 10 buyers for that same home. There's going to be much more competition. That home is going to sell for the one that can pay the most for it. So maybe there's a buyer that could afford the 7, and now that 6, it just affords more, so they can make a bigger offer. Now they can say, well, I can give you more for your house and I can outbid everybody else. So I think higher interest rates, ironically, can help people, especially in the lower price range, because you can always get a better interest rate. You can't get the better price on the home. And I see way too many people that are waiting for some magic interest rate, and there's going to be a lot more buyers. I think I saw a report that like for every 1% lower, there's 20 million more buyers for every 1%. Your competition is going to go up. And if competition goes up, especially in the lower price range where there's not a lot of homes in that price range, you're going to get outbid. You're going to be waiting yourself right out of the market. I really think there's a window here, as we have a consensus that there should be better interest rates, that you should jump on if a house is available and it fits your budget today, buy it. Don't wait for the lower interest rate, because the house will either be gone or you'll get outbid, and you're going to have to go pay more for a house with the better interest rate. I think there's a window here that people are just missing out on because they're waiting for either a crash. And that's the funny thing about the crash. It's like, okay, even if there is some sort of correction, it's not going to be on the lower end. Even in 08, it wasn't like the lower end homes really suffered. It was more the upper end homes that suffered because there's less buyers in the upper end. So if you're in the lower end anyway, you're already limited on your supply, and demand kicks up in that, there's not going to be a crash. There's not going to be this, because there's just not enough inventory. There's not enough homes for a crash. There's no foreclosures. Existing homes aren't for sale as much as they used to be. So this idea of a crash is wishful thinking at best, and bad advice, especially if you're in the lower price range, especially first-time home buyers. So what you need to do is get with a family member, a friend, get into that first home. Split the first one if you have to. Brother, sister, roommate, get 3 people together and go buy the first house. And then as rates get better, or you build up that equity, then maybe everybody splits apart, or maybe one person takes over that home and the other one moves out. I think that's what you're going to see a lot more is these co-signers are kind of people having to team up for their first home because there's a huge benefit to that. There really is. So yeah, got on the soapbox on that one for a little bit, but I mean, I have so many people waiting for a crash, waiting for lower interest rates. Those don't produce crashes. Those are not things that will produce crash. What's going to produce crashes is a huge decrease in equity, a huge uptick in supply. So that means way more supply than demand, which it's we're like 20 million short of any kind of supply crisis. So I don't, there's not going to be any kind, there may be something in 10 years, 5 years, maybe there's something, maybe there's certain areas. I mean, real estate is very local. You know, if you have a a town that's really dependent on an industry and that industry just goes away or something happens and all the jobs go away and everybody just moves, then all of a sudden there is a huge uptick in supply and a huge increase in foreclosure activity because all the jobs went away. So local real estate's still going to be local. So don't get me wrong. And we're talking about kind of overall concepts, but I think there's way too many people waiting for a crash or better interest rates that'll just price them right out of the market. It's only going to get worse. And if there's a home you qualify for today and a price range that you qualify for, get into that house because the payment's only going to get better if rates get better. Your value is only going to go up over the next 5 or 10 years that you own the home, and then turn that one into a rental and then go buy another house on top of it. I'm a big believer in real estate. I really am. There's just way more benefits that come from owning it than renting. All right, soapbox over for now. Next one is teed up and ready to go. All right, here we go. Let's go to another question. Is it harder to get a mortgage for an investment property than your primary residence? Yes, in a sense. Investment properties do require more money down. They do require a higher interest rate. So the qualification can be a little bit harder, but it's not necessarily harder to get the loan. It's just the qualifications are different and the qualifications can be harder, if that makes sense. So primary residence financing is less money down. It's less risk. It's usually better interest rates. There's a little less hoops to jump through in some senses. So yeah, is it harder? Yes, but it's harder for different reasons, if that makes sense. But primary residence is going to give you the better rates of terms, less money down than an investment property. There's an easy one. How are we doing on questions? What's this little button here? Oh, I hit the learn more button. Oh no. Oh, there it goes. I thought I just dropped everything. All right. Golly. Boy, I hope the microphones work. I mean, here we are. Check out my office. What do you guys think? I got some stuff from Alaska. I got this Tahoe. Oh, it's inverted. So this thing is really cool. All right, there we go. Now I got it. This is like this Lake Tahoe thing I really like. It's like a 3D topographical thing that goes the dead. I know, I love that thing. So, all right, what else we got? What distinguishes unsecured home equity loans from those that are secured by the value of your home? There's no such thing as an unsecured home equity loan. It's secured against the home. That's the collateral for the loan. So you're not going to get a home loan that isn't secured against the home. So unsecured home equity loan doesn't make sense. There is no such thing as an unsecured home equity loan. The home equity, the home is the collateral for the loan. So it's secured against that asset. It's secured against the home. Unsecured is like visas, where you're signing your name. There's no car they can take away. There's no house they can take away. They're just signing on the dotted line based on your credit history and the interest rate and the risk. And that's what unsecured is. It's something that's not like a gas card, a Visa, an overdraft, or overdraft. It's not secured against something, so they have no way of taking something back other than dinging your credit or not allowing you to use the line of credit anymore. I mean, there's a recourse they can do, but secured is saying, okay, if you don't make your payment to me, I get to take something back. The car, the motorcycle, the RV, the house, that's what I get to take back if you don't make your payment. So because it is secured, it's better rates, it's better risk. Lenders are more willing to lower better rates and all that kind of stuff because you can't just walk away and they can't get some of their money back by at least selling the asset the lien is tied to. So there is no such thing as an unsecured home equity loan. Can I take a home loan from one state and buy a property in another. Can I take a home loan from one state? Not the one that's secured against the house. If you already have the loan against the house, you can't just take the loan to another state. Also, there is requirements in certain states to get different loans. So if you're approved in, say, Nevada, that approval may not carry over to Utah. Now, it depends on the loan program that it is. So, but the saying here is, can I take a home loan from one state and buy a property with another? Maybe. The answer, I think, is maybe in that, because it depends on what type of loan it is. If it carries over, there might be different criteria, different, like Utah housing, for instance. There's a loan that's called Utah housing. They don't do Utah housing loans in Nevada. So, but it's an FHA loan. It's basically an FHA loan, which FHA loan can go to the other states. So that's where it's a maybe question, but most likely no. I think in the context, I'm kind of reading into this question, I would say no. Oh, how do you maximize your chances of getting a loan against a property? Credit, make sure your credit and payments are made on time. Make sure you have some reserves on top of down payment, and job stability. Those are the things to maximize your chance of getting a home loan. That's really so many of our guidelines fall into those three categories. Job history, which is part of debt ratio, income, income situation, assets, down payment, and reserves, not just down payment, but also having some money left over, and how you made your payments in the past. Those, it's amazing how many things fall into those three categories. So how do you maximize your chances? Always work on your credit, keep money in savings, pay down your debts so you don't have a lot of debts you have to service. That's how you get the best loan. Let's see, how are we doing on time? Let's go maybe 9 more minutes or so. I don't know, maybe we'll see. We're just having too much fun on a time of recording. What day is it? Wednesday? Oh man, it's Wednesday. How much home loan should I take if my monthly in-hand salary is $130,000? So there's more than just a factor of your monthly in-hand. We do go off of gross in most cases. If you're self-employed, there's different calculations. So there's ways we calculate, okay, what is the most reliable, most consistent monthly income of this client? Then we take the other debts. So you can have 130,000 in a month. Wow, that's a lot if I'm reading this correctly. 130,000 a month, that's a ton. You'd be able to qualify for a lot of loan. But a lot of it, when you're talking about the normal client, you're going to have their yearly salary, their yearly W-2, their tax return, whatever they have is their gross monthly income. You're going to take 50% of that usually, and all of their debts have to fall under that number, including the new mortgage payment. So we have these formulas, these debt ratios to kind of calculate how much new debt can they take on, how much can their mortgage payment be, what other debts can we pay off. So a lot of times I'll sit down with clients that have a down payment and say, well, actually, we can increase your buying power by getting rid of a car payment or a Visa or some other debt instead of putting the extra money down on the house. So part of my job is to maximize debt ratio or look at the overall situation. How can we get the most out of this client needs? But there is a debt ratio in almost every single loan that is factored in some way or another based on what we show as verifiable income. So if you have 130K net per month, that's a lot. So I don't know if that means, anyway, the question could be 130,000 a year. It could, I don't know, but how much of a home loan can you get with $130,000 a month? A lot. You'd be able to get a lot, depending on your other debts. I mean, hey, if you got 100,000 in monthly debts, then it's going to be a whole different story. So that's an interesting one. All right, how we doing on time? What a question to almost end on. Almost end on. We're not done yet. Oh, what fun do we have on these calls? So much fun. What are things we need to consider before buying a house? Boy, there's so much. That's where having industry professionals, having a mortgage officer that's helping you through the loan process, having a real estate agent walk through the home, doing a home inspection. I would say one of the biggest things when buying it is get that home inspection done, because it's so many things that can pop up, or just get your eyes wide open, or find out, hey, this house isn't worth buying. But one of the things to consider before buying a home is just keep your savings. In fact, here's a good tip. So if you're paying $1,000 per month for rent, but your payment's going to go to $3,000, start paying $3,000. Start paying what your payment's going to be. Now, how do you do that? Put it in a savings, put it in a money market account, put it in some account where you're kind of making that payment, see how that affects your budget. If all of a sudden you can't make that payment every month, maybe tackling a $3,000 mortgage payment isn't going to be a good thing for you. Kind of, there's some discipline you can do there. I would say build up savings and emergency funds and reserves. Have some of that to fall back on because there may be some repairs on the house that you have to deal with. But I would say the best thing I can say after you get it under contract is get that home inspection, get the home warranty, just get some things to kind of help alleviate some of that cost when you first buy the house. But what are things to consider before buying a home is start prepping yourself for that higher payment. Start making that payment to a car payment, or to savings or emergency funds. Say, okay, this is our new mortgage payments going into this account, and don't touch it until you need it for the down payment. Or if you really can't manage it, say, hey, I can't handle a $3,000 a month mortgage payment. I can't go from X amount to X amount. So that'd be a good tip, is to just start paying yourself your mortgage and make sure that that's something you can handle. And it just is a good practice to be able to kind of get more money going into these savings accounts. So I think that could be pretty helpful. Oh, well, hello. Somebody in the chat. How are you? All right, what else we got here? Let's see. Is it harder to get a home loan on a mobile home? Yes, because the mobile home doesn't qualify as real estate unless it's on a permanent foundation. Otherwise, it's a car loan. So it's really not a mortgage necessarily if it's just a mobile home in a trailer park or not on a permanent foundation. So it can be harder to get the mortgage loan if it isn't real estate. Now, if it is, it's no different. So if it's on a permanent foundation, you do have to get a foundation cert. So there's a couple other things, but and it has to meet certain criteria. It can't be a single wide, it has to be a double wide. So there is some criteria to qualify, but if it qualifies for a mortgage loan, it's not harder. But these mobile homes are sometimes harder to qualify for a mortgage loan. So that's where it can be a little bit different. If your home loan is rejected by a bank we are currently with, can you get approved with another bank? Absolutely. It depends on what loans that bank offers. Now, some banks don't do FHA and another lender would, and you could qualify on an FHA loan. Or I would say most of the banks you're going to do your day-to-day checking and savings are going to be a little more strict than a mortgage company that handles only mortgages and not car loans and visas and checking accounts and all the other things. So like credit unions and banks are usually more strict than us as mortgage lenders, just because we have a bigger pool of investors that we can pull from, and we just have more products to choose from. So just because you're rejected by one bank, especially if it's a direct bank, then I would say in most cases that's like the checking and savings where you do your banking, that we as mortgage lenders will have more lending options that'll be a lot more flexible than the credit union or bank that you're with. So if you do get turned down from there, find out why. They should give you a reason. If it's credit score, debt ratio, maybe you'll still get denied at another bank. But most of the time, those lenders are going to be more strict than what we will be, especially if they don't do FHA loans. So if the lender doesn't even offer that FHA loan, you're missing out on an entire product that usually can get you approval where the bank can't. So it's definitely worth shopping around if you get rejected, depending on what the reason was. If it's credit scores, that's going to carry over to almost every lender. But if it's something else, maybe they don't allow a debt ratio over 40%, you're 42%. Well, I've seen lenders go up to 60% debt ratio. So where some banks will say, no, cut and dry, this is a hard stop. Doesn't matter down payment, doesn't matter credit score. Once you hit a certain debt ratio, it's just a no, where we're going to have more flexibility when it comes to that. And because all I do is mortgages, I may have more solutions than somebody that's pushing just one lender's program. That's just kind of that box. If you don't fit in it, you're done. So I can help you with Utah, Nevada. I have lenders I can refer you to in other states. Patriot that I work for is licensed in a bunch of different states. So I can answer questions, point you to the right person, or see if I can help you if you're looking in Utah and Nevada specifically. All right, what else we got here? Can a person with an eviction, what is the average mortgage for a single family home currently? Depends on the area. Real estate is very local. Depending on kind of what county you're in, what state you're in, you're going to have a median home price. Here in Southern Utah, I think the last time I saw was about $450,000 is the median home price. I think that's actually up a little bit and then down a little bit. And it depends on the down payment. So the purchase price might be different than what the down payment is, but I'd say most of the new loans are somewhere in that $400 to $450 is the median. So there's going to be people less and there's going to be people way more, but it is very local. Real estate is local. What's in Idaho might be different than what's in Las Vegas or California. I mean, California is probably even more than that. So it is going to be a little bit more local, but I would say the national average, I think, is right around that $400,000 number. Is pretty normal for the national average is what we're seeing. And we're a little above that. Where I'm at in Southern Utah, we're a little above that national average. Thank you for the question. All right, what else we got here? You know what? Let me go to a new section. Let's see what this section pulls up. Here's this question. This question pops up probably as much as anything else that I see. Is one, can I buy another house with another mortgage? And we kind of answered that a little bit, but here's the question that I think I see the most. How can I get a loan with bad credit? And there is lenders that will loan on anything. I mean, there's a payday loan company, there's a car loan company. I mean, people will loan money to everybody, but it's amazing that if you can work on your credit, you'll get better loans. So yes, we can do mortgage loans down to like a 500 credit score, but the rates and terms are not going to be very good, and it really hurts your buying power. And it's not crazy hard to get the score up to where you get these better loans. You don't need a 700 score to get a mortgage or get 100% financing. We can get down to a 620 score and be 100% financing with better rates. But as soon as you're 619, 599, 579, as soon as you kind of hit these tiers, it just gets worse, and it's not hard to get the score up if we can spend some time to get it fixed. So I see that question a lot. Can I get a mortgage with bad credit? Yes, you can, but why not work on the credit and get a better loan? Why not spend the time to get the better loan by fixing the credit and fixing some of the habits that led to the bad credit? And car insurance, home insurance, car loans, everything's tied to credit. So working on that will help you not only with a mortgage loan, it'll help you with everything. So it's well worth trying to do that. All right, what else we got here? I wanted to see if let's see if there's a credit. Let's just go like general credit. We kind of jumped on that a little bit. Let's see if there's anything about credit. Okay, here's one. What are the best ways to build up my credit score? So obviously not having any lates, that can hurt your credit as much as anything is just having some sort of late payment, a cell phone bill, you didn't turn in the cable box, or you didn't turn in the internet modem. I see that all the time. It's just crazy how often I see a stupid little collection on equipment rentals, or stuff like that. But one of the best ways to start building credit is to get some sort of credit card, whether it's a gas card. I mean, some of these gas card companies, some of the overdrafts, they'll approve you with a pretty small amount to get you started. You don't, and it's amazing how you get just at least a little line of credit somewhere. But here's the trick with any line of credit that you have, is you don't want to borrow more than 30% of its limit, but not zero. So you want to have a small balance, but not over 30% of its limit. So just for easy numbers, you have a $1,000 limit, try not to borrow more than $300. Now, people tell me all the time, well, use it, pay it off, use it, pay it off, use it, pay it off. But whatever's on your statement is typically what the credit card will report to the credit bureaus. So if it's all the way up to $1,000 and you pay it off that second, they don't see it until the next billing cycle, and you could have borrowed back up to 1,000 again. So it looks like you're always at 1,000 every single month. So the trick is, if you can keep it under 30%, you'll see the biggest jump to your credit score. So either pay it early before the statements go out, or just in your head say, okay, it really isn't a $1,000 limit, it's a $300 limit, and I just want to make sure I keep it under that number. So if you go over it, just try to pay it down back under that number if you can, and not to zero. If it's all the way to zero, it doesn't really factor into the algorithm as good as if it has even a $50 balance on the card is better than having it be over that 30% or back to zero. It's one of the best ways to improve and start working on your credit is the revolving lines of credit. And it's going to take some history. Usually they don't really start reporting as well until you hit 6 months on installment and these other types of debts. So you're going to have to build some history with just some time, but you got to start somewhere. And revolving accounts are one of the best ways to start. You can also do what's called boosting your score, which is reporting with Equifax, Experian, TransUnion, other payment histories like cell phones, insurance, car insurance, utility bills. There's ways you can actually report that you've been making that payment on time, which can help you build that trade line. One thing that doesn't help your credit is authorized users. So let's say mom and dad have a credit card they've had for 10 years. They just add you to that account. Even if you don't get the card, they just add you to that account. That doesn't factor in anymore. But it can hurt you if they start using that balance to limit ratio, and actually can factor in and actually be a negative, but it doesn't give you any positive. So this was an old trick years ago. And I still see it float around once in a while that, hey, just add them to an authorized user and your score will go up. The credit bureaus got wise to that years ago, and doesn't help your credit to be added as an authorized user. You need to be added in as an actual borrower, or just get your own card. Now, let's say you get denied. Say nobody wants to give you a credit card. Maybe it's bad credit, lack of history, whatever it is. You just keep getting turned down for credit cards. Here's the next best thing you can do is look for a secured visa. What this means is you're bringing in the $300 to Wells Fargo or Chase or a couple credit unions I know locally will do it, that then they give you a $300 Visa. Now, the trick with that is they don't always report to all 3 credit bureaus. And a lot of them that you see online, they'll want $1,000 cash from you and give you a $500 Visa. So you have to give them more money than they're loaning to you. But that's one of the other ways. If you're rebuilding after a bankruptcy, these secured visas is something to look into. But the same premise takes into consideration. That balance to limit ratio is a big factor on your score. So if you get a visa, whether it's secured or unsecured, and it's $1,000, use less than 300 each month. You'll keep it under $300. You'll see a big boost to your score as little as 1 or 2 cycles. So it depends on when you get the card, when they do their billing cycle. But I've seen people have big jumps to their score in 30 or 60 days, depending on, again, on the timing. If you get the card right on the 15th, you might have missed the cycle and you have to wait till the next month when they report, and then you start seeing the boost. So these things take some time. Way too many people have bad credit, want to get it fixed, get all excited, get on the soapbox, get ready to go, and then they don't do anything about it, wait 6 months, and like, oh man, I should have been working on my credit. Yep. These are little things you can do to boost your score right now, like starting in the next 30 days. Revolving accounts are one of the best ways to do it. Now, you still got to build up the positive while you're working on the negative. So you got to dispute, you got to pay off, you got to settle, you got to do stuff. You just got to say, you know what? I made some stupid decisions. I just let these things go too long. Now it's time to regroup and just see if people will settle and just get these things moving on. Now, maybe there's medical. I mean, there's going to be other reasons why people have these problems, but it is something where working on your credit is one of the best things, not only for a mortgage, but for anything else. Let's see. Oh, all right. Let me grab my mortgage calculator. We have got a question. Assuming a $450,000, and I have a mortgage calculator right on ryanbolton.com. So if you scroll down, you'll actually have these really cool calculators right on my website. So go to ryanbolton.com and check out the mortgage calculator. Let's say we got $450,000 mortgage at a credit score of 750. Part of that's also going to depend on what the value of the home is. So if you're borrowing $450,000, it's worth $450,000, the rate's going to be worse. If you're putting $50,000 down or $100,000 down, that's going to lower the interest rate. So that's why there isn't just an interest rate. There's not just a payment, because is it owner occupied? And that's part of my job as a loan officer, to sit down with a client and do their specific scenario to get them the actual rate they're going to qualify for. Because if 450 is 100% financing, it's a different rate. There's going to be mortgage insurance. If 450 is a refinance and the home's worth $100 or $1 million, the rate's going to be better. But just to give, I mean, this is probably, I mean, it's hard to do a quote like that because you don't know exactly what rate they're going to qualify for. But let's do some math here real quick. Let's say it's a 7% interest rate, with rates are below that, but let's just say it's 7%. Let's say there's no mortgage insurance. The payment would be $23.95. So $450,000 at 7% would be a payment of $23.95. What you have to add to that is mortgage insurance if it's required, tax insurance if it's required. That's what I said. There's not just one rate, one interest rate, one payment for everybody. What's the credit score? Maybe the rate would be better than worse. So that's part of my job, is to sit there and say, okay, what are you trying to do? Are you trying to buy or refinance? Are you putting money down? Or are you not putting money down? Is your credit score lower or higher? Is your income, your other debts? Do you qualify? All these things factor into what the end interest rate you're going to get, which will then determine what your payment's going to be. But in this scenario, if you're $450,000, 7% interest rate, the principal and interest will be $23.95. But go to my website, ryanbolton.com. There's a mortgage calculator on there that will factor mortgage insurance. It'll factor taxes and insurance. It'll give you numbers to show what the total payment's going to be, because that's just principal and interest. There's other things that go into your mortgage payment. So I appreciate the question. That's really good, but it's a tough one to answer because it's not just everybody gets the same rate. Every loan gets the same rate. Every loan has risk adjustments that determine the rate you're actually going to get, which then determines the payment you're going to get. Great question. Thank you. All right, let's see what else we got here. We got some more time. Let's go into some more credit questions. How can I get a personal loan if I have bad credit? You can. There's going to be people who loan to anybody. You know, if you want a 30% interest rate, somebody's going to loan you the money. You know what I mean? There's going to be payday loans. There's going to be stuff that's going to pay it. But again, working on the credit is going to open up more doors than just trying to fit into any loan that's out there. So, yep. Oh, I saw this question the other day. Can hackers change credit scores? That's a very interesting question because I don't think so. And everything could be hackable. Everything's on computers, but credit scores fluctuate based on the data that comes into the system. So even if you could hack it, it would only be good until the next credit bureau reports. In other words, let's say you hack it on the 10th of the month, and on the 11th, the credit card reports, or the mortgage reports, or the car loan reports on the 15th. Then all of a sudden, that hack to get the better score is gone because now the new data shows up. So credit scores are really, and that's where I have people say, why did my credit score change so much? Or, why did it change? Because new data comes in every month. Your balance to limit changes, maybe an inquiry, maybe now you've hit a 6-month mark or 12 months. Something has changed with the data that's come in and the algorithm is adjusted and bam, there's a new credit score. So it can change literally not every single day necessarily, but it will change a couple times through the month depending on the timing of when the creditors report. Like a lot will report on the first of the month, the 15th, the 10th, the 25th, the end of the month. They'll report at kind of different times, and it depends on when you pull it. That's why as lenders, we'll pull all three of the credit bureaus and use the middle score. And usually I would see that most of the time they're about a month behind. They'll start reporting for September what happened in August. They'll start reporting, so it always seems like it's about a month behind the actual payment schedules because they'll usually report at the end of the billing cycle, kind of when the payment's due or within the grace period. There's all kinds of ways they report. It can be different. That's why it can change not every day, but I would say it could change a couple times throughout the month. All right, let's go to a couple more here real quick. Oh, this is so much fun. Let's go to just real estate. What is the difference in mortgage rates between your old and new house? I wonder if that's just like a general question to everybody. Well, in most cases, people have higher rates now with the loans they can get than the old home they owned 5 years ago. But it's funny when you talk about interest rates with people, you'll have people that are older that say, I remember when rates were 12% and 18% and all that kind of stuff. So it's kind of a funny thing. It depends on how old you're talking about. But I would say because rates have been higher for the last 3 years, maybe we might be pushing on the 4-year mark than what was available before that for about 5 years. I mean, we had a 5-year window where rates were below the 70-year average. We still are below that, but we're almost right to the 70-year average. So most people, their old home probably was a lower interest rate than the home they're getting today. But a lot of it, there's other reasons to own the home. They have to move, relocate, upgrade, downgrade, whatever it might be. And still owning a home is better than renting. I mean, what's your interest rate on the rental? Way worse than mortgage rates. What other real estate questions can we get? Can you buy your parents' home and let them live in it? Sure, sure. Why would you think you couldn't? Um, there's ways to do it better if they can co-sign. If you can co-sign for them, let's say the parents can't qualify, as long as they have the credit scores, maybe they don't have the income to qualify, you could co-sign for them. It could be their primary residence still, so you can get better rates and terms. So there's ways to get better rates to structure it correctly, but there's no reason you can't buy their house and still let them live in it. Now, how you get your loan will be important. So if you buy it as a primary residence for you and they're just staying in the home with you, the financing can meet that. But if you're buying it as a rental property for them, you have to make sure you're getting the right mortgage. Otherwise, you're potentially committing mortgage fraud by basically saying, I'm buying mom and dad's house, but I'm never going to move into it, but it's going to be my primary residence, but it's their prime. So you want to be careful with the type of loan that you're going to get. But here's one other tip I can give you as I'm just kind of thinking this through. I'll have people that say, well, I can buy my parents' house for $200,000, but it's worth $400,000. What you can do as a family member is you can say, okay, we're going to set the sales price at $300,000, gift the $100,000, so then I only need the $200,000 loan. So they still net what they need to net, but you can use the equity to get rid of mortgage insurance, down payment requirements, those types of things. You can structure it in a way to where you don't have to come up with a down payment, because loans, when you're buying a home, go off appraised value or sales price, whichever's less. So the house could be worth $1 million. Your parents have been in it forever and they want to cash out some of their money, but they still want to stay in the home. You're going to figure out your family's situation. You want to structure that loan to where you don't have to do a down payment, have higher interest rates because you have all that equity, so you can tap into it in a sense. There's ways you have to do it. There's guidelines. You have to gift of equity. There's guidelines you have to follow, and you have to qualify for that type of loan. But I see so many times where people say, well, I don't need, I just need 200,000. I'm selling it to my son. So I'm going to set the sales price at 200,000. It's like, well, okay, now they have to put a down payment. So, well, yeah, but the house is worth 400,000, 500,000, 600,000. Yeah, but you set the sales price at 200,000. So set it at 3, set it at 5, set it at whatever. Then you can do a gift of equity for that difference. Now there may be some tax things you have to look at. I mean, there's some things you have to look at, but generally that's a good way to be able to get the better loan for the kids if there is a bunch of equity you're just trying to essentially work with. And so there's ways to structure it that can be a lot better than just doing, or unless the kid already has the down payment, doesn't really care. But generally speaking, they're trying to get the mortgage at the sales price, and it doesn't work that way. Unfortunately, you have to structure it the right way. All right, what else we got here? How are we doing? Boy, we're doing great. We're doing great on time. Are you holding out renovating your home in hope mortgage rates will drop further? Oh, that's an interesting question. The thing I see with that is, okay, so if you're waiting to renovate the home and you have a great interest rate on your loan, it most likely will never get low enough. I mean, I can't imagine, depending on the rate, I can't see it getting dramatically lower than 4% in decades. I mean, maybe never. I mean, to see rates under even 5 over the history of mortgage loans is crazy low for mortgage rates. It really is. So if you got a 4% interest rate and you're waiting for rates to get back to 3 before you renovate your home, you're going to wait yourself right out of it. So the most common thing people are doing is not refinancing the first, keeping their great rate on the first, and adding a second mortgage. So you can add this mortgage that's just a separate loan for 50 grand or whatever you need to do to renovate, and just have a separate payment on this while keeping the payment on the first. That's much more common. And there's no reason to wait, I would say, for rates to get lower to do the equity or to do the renovation loan, because you can start using the home the way you want to. So if you're holding out hope that rates will get lower so then you can do your renovations, I would say look at the terms of a second mortgage. Look what you qualify for. Talk with a loan officer. Talk with me. Let's run some numbers for you and see if it makes sense to do it now versus waiting until rates get below your current first mortgage rate. Because there's these other loans. There's other loans that you can do where you leave that loan alone, leave that great interest rate where it's at, that monthly payment, and just add the second. And the second mortgage is going to be cheaper than a Visa or some other type of debt to do the renovation, a Home Depot gift, Home Depot card or something like that. The mortgage loan is going to give you way better terms than any other type of debts that are out there. So I would say look at doing the renovation, second mortgage, HELOC, home equity line of credit. Look at that type of loan before you wait until rates are better on your first mortgage. So hopefully that makes sense. All right, let's see what else we got. Questions. My boyfriend wants to get married to use my income for a loan on a house. I hope there's more reasons than just that. I hope there is, but my boyfriend wants to get married to use my income for a loan on a house. He wants me to sign a prenup. What should I do? Wow, that's interesting. That's up to you. I mean, when you're on the loan, you're on the asset, you're on the debt. It depends on how the prenup is set up. So I would say, okay, what do you want on the prenup? Do you get the whole house, even though you're using my income, you're using my assets, or we come up with an agreement that says, okay, once we decide to sell, if there is a divorce, we get to split the equity, or we get. So I mean, it's if there's a conversation about a prenup, then you talk about the prenup. Say, okay, what terms do you want on this prenup? Everybody says, I want a prenup. It's like, okay, what's in the prenup? Then you have to get into the weeds. Okay, well, if we get divorced, I want to make sure I can keep my guitars. I want to keep, or I want the entire house, or I want the car. You'll be able to go through kind of the assets that you have, and it'll have in the prenup, okay, what happens when you acquire new assets? And so if you have that, I mean, there's something about a prenup that's kind of weird. That's either people just totally against it or totally for it. But really, it's like, okay, dig into the weeds on what they want in a prenup. Okay, so you want a prenup. Don't just dismiss it because it's a prenup. Dismiss it because the prenup says they get all your stuff. Then you say, no, I don't agree to that prenup, but I would agree to one that if divorce happens, we come up with some sort of agreement that, okay, I get this, you get that. We've already got it decided. It's kind of out of the way. And that's what I would say is, okay, just because he wants a prenup doesn't mean he just gets everything. It's like, okay, what's in the prenup? Just ask the next logical question is, okay, what is included in the prenup? This house, this car, your collection of baseball cards. I mean, what's in the prenup? And then that way you can determine whether or not you should sign it or what negotiation you can do ahead of time. And you'll find out, okay, do I want to be married to this, it's a way to investigate and be dating and venting out this person you're going to marry. You want to just have those things in place. That's why prenup exists, is maybe they have had a bad experience in the past and don't want to get, lose a house again or just go through a divorce again. They say, I'm not going to go through this again. I'm going to make sure ahead of time, if we acquire assets, it's agreed upon, we're going to split everything. Okay, then you decide if you want to sign that prenup or not, or get married to that person. All right, how are we doing on time? Any other questions in the chat? Thanks for jumping on, everybody. Okay, I'll make sure. Thanks for the questions. Please ask any other question. Maybe we'll stay on. We'll round it up to maybe an hour and a half here. But I just think this is fun. All right, let's just go back to mortgage. If we're going to only have 10 more minutes, let's find one more mortgage. That's what we do here on the Mortgage Nerd Show, is mortgage. Mortgage, slow death contract. Here's an interesting one. Can an HOA keep you from selling your home? Ooh, I don't know if I've ever heard of an HOA say, no, you can't sell. You can, they maybe will prevent it if you owe and all of a sudden now you can't pay that obligation with what you're selling the house for. So if there's like but then that basically means the buyer has to assume, okay, so let's say there's a situation you owe a bunch of HOA and you're selling the house for less than what's owed and you're kind of getting out of it. And then maybe the HOA can't prevent you from selling it, but then maybe they won't let you transfer ownership without paying that bill or agreeing to it. So it usually falls onto the buyer, and the buyer's going to be like, I'm not going to pay your HOA thing for you. Or maybe they have to negotiate that as part of buying the home. So I'm sure there's some sort of situation where it becomes an issue of what's owed to the HOA or dues that are past due or some sort of reinvestment fee of some kind. But strictly, if it isn't involved in that, I don't see an HOA that says, no, you can't sell your home. One other thing you can do is there's HOAs that do have restrictions of like age, like 55 and older communities. So maybe they say, well, you can't sell your home to that person, but even then they can sell it to the person, they just can't live in the home. So even in that situation, HOAs can't stop you from selling it, but they can say, hey, you can't occupy this property because you're not 55 and older. So you can keep it as a rental. You could rent it to somebody, if they don't have rental restrictions. So that there's some nuance maybe there, but I can't think of a situation that prevents you from selling it other than the debt that could be owed on it. But it still wouldn't prevent you from selling. You just have to reconcile what's owed. Maybe that's a good one. All right, we got some more time. Let's see if there's more questions, but that's an interesting one. Can an HOA, and if everybody knows, put in the comments. I'd love to talk to you about it. If you've seen a situation where an HOA said, nope, you can't sell your home. There's got to be a reason. It's either you can't, and even then, you can't restrict somebody from buying in an HOA community. That's equal housing and fair housing issues. I don't think you can prevent somebody from buying it. You can prevent them from occupying or living in it. There's restrictions there within the CC&Rs, but not selling it. Yeah, you can't prevent somebody from. Otherwise, you could come up with all kinds of reasons. Well, you can't sell your home to women or underage people or kids, or you can come up with rules that the HOA could come up with that would violate fair housing and stuff like that. So I don't think an HOA can prevent you from selling it, other than the fact that you owe us $5,000 and we're not releasing your obligation on that until you pay us, and then you can't sell it without paying that. So that there could be kind of weird way, but it still wouldn't prevent you from selling it. But anyway, okay. Let's see. Are lenders aware when you check your own credit score? No, because it usually doesn't pull up as a credit inquiry because you're not applying for debt. So you can check your score. You can go to Experian, TransUnion, Equifax, and pull your actual score. It may not be the same you'll see from a lender because, again, they use different scoring models, and your credit score with the lender is going to be a middle of the three. So maybe you go to Experian and you're a 700, and then they pull in you're a 680 because they use the middle score, and they're like, oh, why is my score not the same? But no, typically lenders don't be aware of you pulling your score because it's not an actual credit inquiry. Same with like car insurance or homeowners insurance. They will sometimes do a credit check, but it doesn't pull up as a credit inquiry in most cases because it's not really applying for a loan. It's checking maybe credit worthiness, which can be different models. So I would say generally, no. I don't see a situation where I've ever seen a credit inquiry that's personal or me. It's always a lender. It's Capital One, it's Chase, it's MasterCard, Visa, it's that inquiry that shows up, not you just checking your score. And you can check your score to see where it's at all the time. In fact, I recommend it. You should be checking to see if anything's popped up. You should use guards. You should freeze your credit. Go to TransUnion, Equifax, and Experian. You can lock your credit to make sure nobody has access to it. Nobody just randomly pulls it without you really knowing that they're actually pulling it. Really recommend you lock your credit with the bureaus. I think they charge like $25 a month for all kinds of other features within Experian, TransUnion, Equifax. I think it's well worth it. Identity theft. I mean, there's so many things that can guard you by using some of those protections. But I would say no. The question here, are lenders aware when you check your own credit? No, because you're not applying for a loan. It's not a lender checking your credit. That's where credit inquiries show up. All right, we got 5 minutes. You can jump on, ask a question on a wonderful Wednesday evening. Hope everybody's doing great. Check out Mortgage Nerd. Got my little nerd thing here. I'm a nerd for all kinds of stuff, not just mortgages. I like nerding out on stuff. I love knowledge, seeking wisdom, all that stuff. I love it. So you can go to nerdmerch.com. I got a bunch of fun ways to show off your nerd. I got hats and mugs and all kinds of fun stuff. It's kind of a little side thing. I just think it's fun. But check it out. It's Nerd Merch, and nerd is with an E, or the E is a 3. It's backwards on this, but it's like N3rd. One, it was available. I think it's just a little gamification. I think it's just kind of fun. Is nerding out. Anyway, all right. Let's see how we're doing on time. Let's see if we can squeeze one more in. Oh, why is this in this section? Oh, there we go. Oh, maybe this is, oh, that's why. Okay. I'm in just topics for me. So now it's going into all kinds of nerdy stuff. Almost asked that question. You'd be like, what? All right, back to mortgages. Ooh, why is financing, boy, we got 4 minutes. Oh boy. Why is financing your home a smart investment for your future? Because it's getting into homeownership instead of renting. You're getting appreciation. You're gaining a potential tax benefit. You're also leveraging what you put for down payment. You can get 100% financing on a house. You can't get 100% financing on a stock or a bond or a piece of gold. You got to have the money to be able to buy that, or a chunk of it, or a percentage of it. So home financing gives you a chance to be able to buy things at very little money down, stretched over a 30-year period, so you can debt service that while you're gaining the appreciation, tax benefits, and then turn that into an investment vehicle. Turn it into a rental that somebody else makes the payment. Cash it out and buy another house with it. Real estate has created an incredible amount of wealth because you have a housing expense. Why not own it? You have a monthly bill that goes out every single month. Why not have it be an investment into appreciation and asset? I think the net worth of a homeowner is like 40 times more than the renter. And you look at anybody that bought a home 5 years ago. Do you think anybody regrets a home they bought 5 years ago? Why? Well, one, the better interest rates and the appreciation factor. Now, maybe it won't be as big over the next 5 years, but it will still be an appreciation. There's still a housing expense. Your mortgage payment's locked in. When was the last time you had a rent payment that didn't change? When you get the mortgage, you're locked in. That payment's locked in. Now, tax and insurance can change a little bit, but it's so much smaller than rent increases. I mean, rents, how many people right now are thinking that your next rental renewal is going to go down? Not very many people. Most people hope it'll stay the same. Now, there's exceptions. Sure, there's times where rents go down, but in most cases, you're lucky if it stays the same. Most of the time, it's going to go up. So even less to show for it. So it's a smart investment because you're already going to have that expense. Why not own it? Why not gain the appreciation? Why not get the investment opportunity down the road? There's just so many more benefits to owning a home. The pride of it. You can have customization. There's so many things you can do with home ownership you just can't do as a renter. How about pets? There's other non-financial reasons to own a home. Customizations, having the thing, having a room, a den of yourself, a backyard, a garage. I mean, there's so many things that come from home ownership. Is it harder to get into home ownership? Yes. Yes, it is. I'm not going to sit here and say, hey, it's not hard, but it's worth it. It's incredibly worth it. Team up with somebody, a brother, a sister, a coworker, or something. Say, you know what? Let's get into a house. You're renting, I'm renting. Why don't we put together our resources here and let's go get 100% finance, get our first house. Just come up with an agreement ahead of time. Okay, we agree to split everything, or you can buy me out. So let's get to the point where it's 2 years down the road. They get married, don't have kids or whatever. Their jobs have changed. You've gotten out of school, whatever it is. Come up with an agreement that just figures that out ahead of time. And then just get into a house. You're making a payment anyway. Team up with somebody if you have to. But it's worth it. It's a smart investment. It is worth it. So let's end with that. I really appreciate you guys jumping on. Check out my website at ryanbolton.com, Bolton. Check out the other videos I have here. I really enjoy doing this. I do lending in Utah and Nevada. I loan everything from Fannie Mae, FHA, conventional, all the normal stuff. Utah housing. We do private money lending, second mortgages. I loan money for a living on real estate, and I want to work with you. I help people with their credit. I help people with all kinds of ways to get them into home ownership. And as we've talked about a few times during this podcast or during this live stream, there's a window right now that you can buy. If you can find a home you can qualify for, you can qualify for the payment. Buy it now. Don't wait. Don't wait for a lower interest rate because you'll wait yourself right out of the market. That home will be gone. And if rates do get better, you can always refinance and lower your payment, but you can't get the cheaper price or that home if it's not available anymore. If rates get better, competition is going to go way up, especially in the lower price range. All these people that want this crash to happen are under the median home price. There's way more buyers are always going to be available in that lower price range, which means there's not going to be crashes in that lower range. Even look at the 08, one of the biggest crashes we've ever had in real estate. In most areas recovered within 3 years, whereas on the higher end of stuff, it wasn't under the median home price. So love to help you. Went on another soapbox there, but love to help you. Love to talk to you about your situation, what we can do to get you in a home. It doesn't cost you anything. Check out my website, ryanbolton.com. There's a mortgage calculator on there. Love to talk to you. It doesn't cost anything. Let's get you into a home. Maybe it's 90 days from now. Maybe it's the end of next year. Whatever. You got to start somewhere. So let's start with getting you the mortgage loan, find out what you qualify for today, and get you ready to buy a home as soon as possible. ryanbolton.com, equal housing lender. My license number is 299717, and we'll see you next time. Where's the end stream? Oh, see you next time.